And now for something completely different.
Forget everything you've been told by others before. Get ready for the real deal, the full story. Real talk about money, markets, life. Now, it's The Real Investment Show with Lance Roberts. Presented by RIA Advisors.
Of course, it is Thursday, second best day of the week, getting ready to go into the weekend. It is also I guess you really can't call it a holiday because we're in memoriam today for the death of Jimmy Carter. So the markets are closed today, so technically it is a federal holiday, but it's just kind of it's not a joyous holiday, right? So just try to put it in perspective. But with no action today, of course, there's going to be a lot of delay in terms of the economic data. Tomorrow we'll get all the employment reports, and so we'll kind of see what happens. But the kind of important thing, and as we talk about markets, is performance so far this year, which has been basically about flat. We're going to talk about the first 5 days of January here in just a second. But overall, market dynamics tend to be okay, but sloppy as of late over the course of just really kind of the last, kind of 3 months in general. The markets are only up about 3%. So, despite, this kind of strong rally post the election, the markets really haven't done a lot over the last quarter. They are, higher, but again, we've given up some of that here just recently. Markets are down about 2% or so over the last month and a few days. So, just really kind of the overall market dynamics have been sloppy lately. And it's always interesting when that occurs because, again, when markets are just going up, everybody's very bullish. But as soon as you start getting to a bit of consolidation, and this is really kind of the subject of this weekend's newsletter as well that I'm working on, when you get in these periods of consolidation, all of a sudden you start getting these really bearish headlines. It's like, this is about to have a crash, this is about to occur. And the markets are really just consolidating a very hefty set of gains that we had really starting in August of last year. So, we had that correction back in August, and markets rallied fairly well, came out of the election very strong. So again, just a bit of consolidation here in the markets is all that's been happening, working off some of those kind of excesses that we had. We had a really overbought condition in early December, just really kind of working that off here lately. But again, this always, when asset prices aren't going up every day, all of a sudden these bigger concerns. So we spent a bit of time yesterday talking about psychology, the importance of having an investment policy and investment strategy. We spent a whole segment on the show yesterday talking about that. If you missed that, Brent is going to post that to our YouTube channel. I don't know if that is up yet. It is up yet. So if you actually go to our YouTube channel, we actually have that whole section from yesterday talking about the importance of investment strategy, having an investment policy, the kind of the rules around that. That's all been posted to the YouTube page. So if you go to our Real Investment Show YouTube page, that's right there for you. But it is important, again, because we have to control psychology, and there's things that are going on in markets currently that certainly weigh on investor sentiment, right? So when market prices aren't just going up every day, investors start to get a little bit more concerned about the markets. When interest rates are going up, it's like, oh my gosh, what does this mean? And we're going to spend a good bit of time today talking about bonds and interest rates and all that with Michael Leibowitz this morning. So we've got a good bit of detail to go into that as well. So, but again, we have to kind of control these narratives that kind of go on and deter us from what we're doing with our portfolios, because again, I don't have any idea what's going to happen this year, and nobody does. And as we've talked about before, analysts are very bullish about returns this year, expecting the markets to rally anywhere from 6,600 to 7,000 by the end of this year. And again, that's certainly possible. We can certainly slap on another 1,000 points on the S&P. We've done that in a year before. So, that's not outside the realm of possibilities, but it's very optimistic, right? It's kind of the outlooks are optimistic, the bullish sentiment's optimistic. There's really no concern about a market correction of any real magnitude, right? And so, and as Bob, and we just recently kind of posted the article on Bob Farrell and his 10 rules, and rule number 9 is when all experts agree, something else tends to happen. And that's a good rule to kind of just live by, is just when everybody's very optimistic or something, or if everybody's very certain about something happening, stocks are going to go to the moon. interest rates are going to the moon, right? When everybody agrees and there is a common consensus of ideas, something else tends to happen. And that's kind of that contrarian thesis that as good investors we want to adhere to, is that when everybody thinks something's going to happen, something often occurs that derails that crowded trade. If everybody's kind of on one side of the boat, something occurs that pushes everything to the other side of the other side of the boat. And that's the thing you want to think about as we go into 2020. What that event is, who knows? How that works out, don't know. But those are the things we want to be aware of and be cautious of. Okay, so let's talk a little bit about the market. Here's what you need to know. Well, I can't really say before the bell this morning because there's no bell. But for tomorrow's bell, here's what you need to know before tomorrow's bell. So the first 5 days of January, we've talked about the Santa Claus rally. The Santa Claus rally did not come. Santa Claus did not visit Broad and Wall this year. He missed it by about 0.5%. The next kind of important, statistical indicator, and again, these are just Wall Street axioms, and this is kind of just averages of how things work out over time. Things don't always work this way. But one thing that investors do pay attention to is the first 5 trading days of January. Now, I realize that today is January the 9th, right? But we're not talking about calendar days. We're talking about trading days. So the first 5 trading days of January ended yesterday, and the market was up 0.2%. So basically flat. But the good news is that it was positive. So the first 5, barely positive, but up 0.2% for the year so far as of yesterday. So the first 5 days of January have been positive. So that triggers the first step of the January barometer. So goes the first 5 days. So goes the month, as the saying goes. Well, if we're only up 0.2% for the beginning of the month, that doesn't really bode well for the rest of the month. We might be up a little bit by the end of the month. But again, this is the setup. So as goes the month of January, so the January barometer is what happens for the entire month of January. So goes the month of January, so goes the year, right? And so historically speaking, if the first 5 days of January are positive, the market tends to be positive for the month of January about 86% of the time. And if January is positive, the average return for the year is somewhere around 7 to 8%. So again, just some good news for you on this holiday shortened trading week and as we get ready to go before the bell tomorrow. So again, just paying attention to that. Now, the other side, technically speaking as well, the market's doing okay here. It's been consolidating. We talked about yesterday that we've got this kind of rising trend line in the markets, and that is kind of holding on here, but just barely. We have this consolidation going on, this compression of price here, this kind of wedge that's developing in the markets. The markets are going to need to break out of this here soon in one direction or the other. If it breaks to the downside, we're going to come down and test the 100-day and then go below that potentially and have a bigger correction in the markets. If the market can muster a rally here and get above the downtrend line here, then of course we can make a little bit of a move higher here. The one concern we have coming up though very shortly, and again, it's not a major concern, but it is supplying downward pressure to market prices, is the 20-day moving average is now is close to crossing the 50-day moving average. So again, if that occurs, that's not a death knell to the markets, but it does suggest more downward pressure. That's applying a lot more resistance overhead to the markets to make that move higher. So again, if the markets are going to make a move and have a positive month, it needs to kind of start on Friday and really into next week as we head into the inauguration. So again, watching that very carefully just from a technical basis, but again, here real short term, the markets are doing okay holding that rising trend line at the moment. So we'll see what happens next. But that's what you need to know before the bell tomorrow, and we'll be back with Michael Liebowitz right after the break.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Small businesses are now being challenged by the lack of employees and how to attract and recruit the best employees. To get the better employee, you'll have to offer a better package. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Don't assume a 401k plan is too costly or complicated for your small business to offer. Let us show you how to make the most of an affordable and effective plan that will deliver true value for your business and your employees. Call me toll-free at 855-RIA-PLAN or online at realinvestmentadvice.com. That's realinvestmentadvice.com.
The Real Investment Show.
When it comes to wealth management, most people think of stocks and bonds, but it's like enjoying one layer in a 7-layer cake. At RIA Advisors, we want to make sure you get your cake and eat it too. Social Security, Medicare, creating a tax-friendly retirement paycheck. Perhaps you're saving for college. How about life insurance, guaranteed income solutions, all along with comprehensive planning? At RIA, a holistic approach to your money is our priority. Call us today, 855-RIA-PLAN, or find us online at realinvestmentadvice.com. Realinvestmentadvice.com.
In 1999, a parafiduciary group of financial advisors were busted by corporate giants for trying to operate in their clients' best interest. These men promptly escaped from a high-cost margin environment to the Houston Energy Corridor. Today, still excoriated by their former employers, they survive as protectors of others' fortunes. If you have a problem about preserving capital, if no one else can help, and you can find them right here, maybe you should hire the RIA team.
You're listening to The Real Investment Show.
Welcome to the show this morning. So just a couple of quick house notes before we get to Michael. Be sure and get by the website, realinvestmentadvice.com. Michael's latest article that we're going to discuss here in a few minutes is on the website now. Also, while you're there, we are starting to get close to selling out of all the seats for the upcoming economic summit that is not this Saturday, but it's next Saturday. So again, if you want to come, we'd love to have you there. It will not be broadcast. It will not be recorded. This is a live only in-person event here in Houston. So love to have you there. Love you for you come in. We've got a block of hotel rooms set aside at a discounted rate if you want to fly in. Love to have you. If you want to drive in, love to have you. We are going to set aside a good bit of time just to visit with you one-on-one as well. So again, if you want to come, we're going to cover a lot about markets and inflation and interest rates and outlooks and all these kind of topics in very deep details. So again, but it will not be broadcast recorded. So if you want to come, you got to get tickets, and those are getting pretty close to getting sold out. So I encourage you, if you're going to do it, talk to your wife, get a pass for the weekend, come on down. So, because I asked my wife, I said, honey, you want to come to our summit? And she's like, no. I'd rather poke my eye out with a screwdriver. So, no, she didn't say that. She said she has to wash our cat, but we don't have a cat, so I'm trying to figure out what that means. Anyway. But if you want to come, love to have you there. So, all right. So, a couple of things. Obviously, interest rates have moved up here over the course of the last couple of weeks. And this started precisely with the Fed's last meeting on December the 18th. You can almost draw a line on the chart and just see as soon as the Fed came out with kind of this hawkish cut, interest rates began moving up. Inflation expectations began to move up. We began to see a lot more concern about inflationary pressures. There's no evidence of an uptick in inflation, but there is a sentiment shift about inflation. And that's been kind of the driver behind what's been going on. And that's, kind of very interesting demarcation. We saw the notes yesterday from the FOMC. and which kind of confirmed their views that they're going to slow down the pace of rate cuts and probably won't get a rate cut at this next meeting that's coming up. But does that really change the long-term dynamic? Because again, the Fed is wrong like all the time, right? I don't know why we, kind of hang so much of our market outlooks on what the Fed says, because they're wrong incredibly often about most everything. So, again, we talked about earlier about, when most experts agree, something else tends to happen. That's a very good indicator about the Fed. But Mike, just before we get into your article and kind of just talking about yields, because again, lots of questions like, yields are going up. What does this mean? What's happening? Just any kind of comments.
Yeah. So the funniest narrative going around is that yields are going up because the Fed is cutting rates, and because the Fed is cutting rates, there's going to be inflation, right? Mm-hmm. So first of all, Fed funds were 0.00 from 2009 to 2016, 17?
Yep.
And during that whole period, the Fed couldn't get inflation up to 2%. So first of all, the link between Fed funds and inflation is not the best. Second of all, yes, the Fed has cut rates by 100 basis points, but how many people in the real economy, whether it's consumers, whether it's corporations, borrow at the overnight rate? Fed funds are overnight loans. How many borrow at the overnight rate? Mm-hmm. The answer is next to zero. The overnight markets are purely for liquidity purposes. They do affect the financial markets, and they have a big role in bank funding, but they play almost a zero role in economics. Now, where do people borrow? They borrow money for 2 years, 3 years, 5 years, 10 years, 7 years, 30 years, right? You buy a car, it's 5, 7 years, 3 to 7 years. You buy a house, it's up to 30 years. Corporations are always borrowing anywhere from 2 years to typically 10 years, gravitating around 5 years. So the Fed has cut rates by 100 basis points, but the market has raised rates significantly. 2-year rates are up about 60 or 70 basis points. 5s, 10s, and 30s are up almost a full percent. So I think it's fair to say that in an odd kind of way, the Fed has made, not what they exactly wanted, but Fed policy is much more restrictive today than it was in September when they started cutting rates. Therefore, the effect of the Fed rate cuts is actually deflationary, because they have put an extra damper on the ability to borrow via higher rates, which will ultimately weigh on growth.
Now, just real quick, because you made an interesting comment, because there was a chart out this morning talking about the numbers of mentions. So basically, when people have nothing better to do, they go through every Fed speech and they create a graph of how many times they mention a certain word.
Right.
The mentions of restrictive policy has now fallen very sharply. So the Fed doesn't think that the policy is restrictive, but yet when we look at the actual economy, the policy is very restrictive. And so it's a kind of an interesting byproduct of kind of the people that are running the Fed and kind of their outlook on things versus what's happening in the real economy. And a good indicator of that is if you take a look at credit card usage just over the last couple of months, there's been a drastic drop in credit card usage because the rate of denials for people getting credit has been rising sharply. And people spending money on credit cards has been dropping sharply because they're running out of money to spend, and they're running out of credit card balances, and they can't get new ones because they're getting denied for additional credit. So when you talk about interest rates in the real economy, it's much more restrictive than what the Fed thinks their policy is.
And look, let's be clear. Fed policy is still restrictive. It's less restrictive. But when you look at real rates, or the difference between inflation and Fed funds, it's the highest it's been since, again, the financial crisis. Mm-hmm. So Fed policy is restrictive, albeit less restrictive, but the market's policy, and that's really what matters. That's what affects the economy, is basically the most restrictive it's been now over the last few years. Mm-hmm. So we have higher rates today, despite much lower inflation than when rates were at these prior levels. GDP is slowing down. It's clear the stimulus is largely out of the system. I'm not saying it's completely gone. Supply problems are completely solved. We're back to a relatively normal economy, yet we have rates that are significantly higher. So again, we're getting to the point, like you said, with credit cards. When are we going to start hearing from banks again? Remember what happened last time rates were here and we were having the regional banking crisis? Those banks still own those same bonds that are now taking those unrealized losses. And if there's another flight to money market funds, because you can earn 5% again, or 4.5%, 5%, those same issues haven't been resolved. They've been painted over. So the problem is rates can go up 100, they could go up 1% today. By the time that we see it in economic data, economists see it, the Fed sees it, it could be a couple months. It takes a while for me to say, you know what, I'm not going to buy a car today because rates just popped up. For lower car sales to show up in any kind of data that can be trusted for economists and markets to see. So what we're seeing today, the effects are happening today, right? There are corporations making decisions not to borrow or to borrow at higher rates and lay off people, but we're not going to see those layoffs or lack of spending or whatever corporations do and whatever consumers do for at least till March or April or May. So there's a big lag effect between rates and when, not when they affect things, but when they show up in economic data.
Right, and it's the same thing in the stock market as well. I mean, when you take a look at valuations, right? We've got valuations that are approaching the highest level we've seen since 2021, and basically those are about in line with each other, and that's the second highest level going back to the dot-com crash. But back in 2021, interest rates were rising, valuations were high, and then of course you had a very big correction in 2022. So you've got this whole issue of when higher borrowing costs that weigh on corporate activity, corporate earnings, those type of things begin to impact markets that are overvalued where they are now. That's the other risk of this. Just not even talking about the economy. But if something happens to the stock market and we start getting a valuation correction in the market, that impacts consumer sentiment. That slows down economic growth. And to your point, that begins to show up in the data that then the Fed says, oh my gosh, I've got to start cutting a lot faster than I was intending to.
Right. And if I'm the Fed right now, I'm a little concerned because I'm in a position where I can't cut rates because of sentiment around inflation. You don't want to push bond yields even higher, but they know that these higher rates are weighing on the economy, but they don't have any justification in economic data to do anything about it. And that's a really tough place. And that's why they're going to make a mistake again. Yeah, it's not a mistake. They just can't do anything. They're handcuffed.
Well, let's talk about, you built a bond model on Wednesday, which is in the website. So when we come back from the break, we'll kind of go through your fundamental bond model and what's that saying, where yields actually should be versus where they are now. And then we'll kind of talk about the outlook for bonds and kind of where we go to from here. Don't go away. More of the Real Investment Show coming right back. Don't go away.
Investment Advice blog. It's required reading for the informed investor. Catch it today at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA portfolio manager Michael Leibowitz, and chief investment strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today. Register today.
Hi, Lance Roberts here. If you're like most people, your 401k plan represents the bulk of your retirement assets, and unfortunately for many, managing your 401k plan can be difficult. There's so many choices, so many things to consider. With just a quick email, a couple of questions, you can put RIA advisors to work for you managing your 401k plan. Just simply click Ask a Question at realinvestmentadvice.com or give us a call at 855-RIA-PLAN. That's realinvestmentadvice.com.
The Real Investment Show.
And now, another page from the Real Investment Advisors Investing Manifesto. Bulls win in bull markets. Bears win in bear markets. Eagles soar above and take advantage of opportunity. Let us help you soar as you reach your financial goals with RIA Advisors. Neither bull nor bear. RIA Advisors, 281-501-1791 or online at realinvestmentadvice.com.
Can't catch the whole show now? Listen to our podcast later at realinvestmentadvice.com.
I think you're really right on that, Lance, and I don't say that often, but
you better be glad we still broadcast on radio. When we come to YouTube, I'm going to tell you what I really think about your comments.
The Real Investment Show podcast.
I know I've got this little safety net right now.
Same show, your schedule.
Can't cuss me out.
Exactly. If we ever go to straight YouTube, man, it's going to be bad.
At realinvestmentadvice.com.
This is going to be an R-rated episode of the Real Investment Show.
If you're working and looking to retire soon, a Medicare special enrollment period is in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid gaps in coverage. Click on the insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
Health and financial security touches everyone within your organization. Offering benefits for all doesn't need to be complicated. Hi, I'm Tom Allen, Senior Benefits Consultant at RIA Advisors. RIA Benefits provides independent expertise to find solutions that speak to the mission of your business, the culture you want to establish, and the budget you are able to work within. Book a free consultation with me at realinvestmentadvice.com/retirement, and we'll find a solution that takes care of your most important asset, your people. realinvestmentadvice.com/retirement, realinvestmentadvice.com.
The Real Investment Show YouTube channel has all our videos ready for your easy access, like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel at realinvestmentadvice.com.
You're listening to The Real Investment Show.
And welcome back to the show. So I'm going to be flipping back and forth here just for a second because we're going to go through Michael's article. Mike, I've just so you know where I am right now. I've got your chart of the fundamental bond model components up so our viewers can see that. So can we start there and just kind of explain kind of what this bond model is and just kind of how we get there and then why this is important to understand?
Sure, and just let me know as you're changing graphs. It'd
Sure.
be helpful. So what are interest rates? It's really the cost of money, right? It's how much does money cost to borrow. Money is what drives the economy. It's what drives inflation. Money is everything. And when you're in a leveraged economy, meaning an economy that's dependent on debt, the cost of money is a key of one of the most critical components of economic activity and ultimately inflation. So there's an extremely tight correlation between those three, and that's not a secret. So what we did was create a model, and we've had a model, but we've upgraded the model to include inflation and to include GDP and 10-year yields. And what the model does is say, if inflation and GDP are X, what should yields be? And then you could say what yields are, and we'll talk about that in a second. So the graph that's being shown right now are the two components, real GDP and the Cleveland Fed Inflation Index. So the Cleveland Fed Inflation Index is a little unique. It's the 10-year inflation outlook. And what they do is they look at current real inflation, and then they look at inflation expectations. Those expectations are from surveys like the ISM, like the University of Michigan, and they're also from the markets. What are TIPS pricing in? What are the market-based inflation expectations? So you get a nice gauge of inflation, both current, a little bit historical, and future, along with GDP. And when you graph it, you can see there's a good correlation between yields and those two factors, but it's not great. So then what we do is we fool around with math and multiple regression, and we can create a model. And that model assigns, how much inflation do you use, how much GDP do you use, and what's the best fit. And with that, we can basically hone in on this line that is, if you go to the next graph, Lance, the line basically tells you, based on inflation, based on GDP, here's where yield should be. And assuming Lance put that graph up,
I did.
You could see, and I'm sorry, I'm kind of half blind here.
Right.
You can see that the two lines track each other extremely well, the orange and the blue line. And then just to the right of that graph, I put a little inset that shows the last year or so. And there's a gap forming. That gap is what we would call sentiment in the stock market. In the bond market, it's called the term premium. Same thing. It's basically you're trying to quantify or explain something outside of fundamentals. So fundamentals, in our case, argue that yields should be, 350. I think it says I can't even see it, 378.
Mm-hmm. Correct.
That's where a 10-year yield should be today, based purely on inflation and GDP. But right now they're at 4. They're actually a little higher. That graph's a little bit old. They're closer to 470. So they're almost 1% higher than where they should be. That's sentiment. And that's important to understand because the bond market, unlike the stock market, sentiment doesn't get out of control. If you have a stock that should trade at a PE of 16, it can trade at a PE of 40. And it doesn't have an economic effect, so it can keep trading at that level. Whereas bonds don't vary too far because ultimately it is GDP and inflation that guide it. And if you look at the next graph, which is a scatter plot, same exact data, it just plots the quarterly occurrences of the model yield and the actual yield on a, and you can see that the regression line cuts right through it. The regression has an R squared of 0.97. That's about as good as it gets in statistics. It's not much more correlated. And you can see the orange dot is where we're at today, and it's actually slightly higher now.
Hang on just a second. 1 second, Mike. You're a little bit, there we go. I had to switch graphs here for really quick for you. But yeah, so what you're seeing now is I've got the actual scatter plot up for you.
Okay.
So you can see how close this tracking is over time versus kind of between sentiment and reality. And what's interesting is if you go back and look at previous periods where the sentiment of the market got ahead of where the fundamentals tell you it should be, the sentiment has always corrected back to the fundamentals, not the other way around.
Correct. And also in that graph are the green triangles. And what that is what happened in 2018-19. And that's important because that's right before COVID. That's right before the stimulus. That's right before the supply line shut down. That's kind of the most recent normal economic data we had. The Fed was raising rates during that period. And there were some signs that we were potentially slipping into a recession, but COVID happened and we don't really know what would have happened. But you could see that if we kind of get back, if that orange dot gravitates downward and to the left, even if the term premium stays, yields will likely get down to 3 or 2%. If that term premium goes away, they can go even lower. So there's two things at play. The economy is normalizing quickly, right? Inflation may be sticky. It's not rising. It's not surging. It may bump around, go up a couple tenths, go down a couple tenths, but it is sticky. GDP is normalizing. The latest Atlanta Fed is, I think it was 2.7. GDP has really come back down to earth, and global GDP is a disaster. You have parts of Europe are in, Germany is basically in a recession. UK is borderline recession. China's growth has slowed dramatically, and if they weren't growing so fast, they'd be in a recession. Their growth was double digits not that long ago. Now it's below 5%. Mm-hmm. And their economy, just for perspective, I believe China's GDP is something like 15 trillion. Germany is 4 trillion. Japan is 4 trillion. So they are the second biggest economy by far. They're struggling. Japan is doing, for Japan, they're doing okay, but their growth is still extremely low. So the bottom line is that the U.S. economy will catch down to the global economy, or the global economy will spike up. One of the two. But right now, signs are that we can't deviate that long. Historically, the correlation between our economy and those economies is massive.
And there's one other big thing about what's going on here that, and again, I want to touch on this when we come back because I've got a bunch of chat comments going on right now talking about fiat currencies and kind of the end of the world as we know it, et cetera. But the one thing that you also have to, and again, to your point about sentiment, and this is where sentiment really is that hedge funds, pension funds, et cetera, when there's a trade going on, as an example, markets can detach from underlying realities and underlying fundamentals. Just like, look, everybody's very willing to jump out there and say, oh, the stock market's just completely, detached from valuations, right? You got high valuations, the markets are going to crash because you're so detached from the underlying valuations. Well, that's because right now the markets are going up, and so everybody just piles into more and more stocks. It just drives stock prices higher. Well, the same thing works in the bond market as well. There are times that prices of bonds can get detached from the underlying fundamentals because there's a trade that's going on, and there's a lot of money flowing into that trade. So if interest rates are rising, then major hedge funds, bond markets, et cetera, they start hedging against their bond risk. So they short bonds against their book, et cetera. Well, that shorting drives the prices of bonds down. Interest rates go up as a function of that. And that trade can last for a while. And the more that interest rates go up, the more they short, that drives interest rates to go higher. So to your point about sentiment and markets, you can have these periods of detachment, but ultimately, just like in the stock market, when everybody gets kind of on the one side of the trade, you're eventually going to get a reversion back to reality. And those realities are driven by the basic fundamentals of the markets. On the stock side, it's earnings. And on the bond side, it's economic fundamentals.
But ultimately, Lance, the difference is that unlike the stock market, when sentiment detaches yields from where they should be, it weighs on those fundamentals.
That's right.
And it actually, it's like gravity. It pulls it down, where stock fundamentals can be extreme for a long period of time. Right. It's much harder in the bond market for that to occur.
Right. Well, and again, this is, so, when we come back from the break here, right, we'll talk a little bit about, fiat currencies, the death of the world as we know it. Again, when people are hawking gold is a good example. There's a lot of this conversation about, nobody wants to own fiat currencies anymore. Everything's fiat. We'll talk about that. And, and again, we'll talk about inflation. We'll come back from the break. Don't go away.
Get daily investment news you can use, delivered at the speed of the internet at realinvestmentadvice.com.
What will a Trump presidency mean for your money? What is the market outlook under the new administration's policies? Register now for the RIA Economic Summit 2025 Market Outlook under a Trump presidency, featuring Adam Taggart of Thoughtful Money, RIA Portfolio Manager Michael Leibowitz, and Chief Investment Strategist Lance Roberts with the RIA crew. Saturday, January 18th. Register today for the RIA Economic Summit 2025 Market Outlook under a Trump presidency at realinvestmentadvice.com. Realinvestmentadvice.com. Register today.
Will you be turning 65 in 2025? Happy birthday! But there's a Medicare special enrollment period in your future. Understanding Medicare choices, enrollment deadlines, and costs are essential to your overall standard of living in retirement. The wrong choices can cost you thousands in penalties. Make sense of Medicare's alphabet soup with RIA Advisors, online resources, and one-on-one partners to help secure the healthcare insurance choice that is right for your lifestyle and budget and avoid those gaps in coverage. Click on the Insurance tab at realinvestmentadvice.com today. realinvestmentadvice.com.
The Real Investment Show.
Small businesses are discovering that attracting and retaining top talent come down to more than just salary. In today's highly competitive job market, compensation is more than just wages. Hi, I'm Tom Allen, RIA Advisors Retirement Plan Consultant. Healthcare and retirement plans can make the difference in hiring and retaining the best employees. We can show you how to build an affordable, effective employment package that delivers true value for your workers and your business. Call me toll free at 855-RIA-PLAN or online at realinvestmentadvice.com.
The Real Investment Show YouTube page has all of our videos ready for your easy access. From 3 minutes on markets and money to each day's radio shows like Technically Speaking Tuesday, Financial Fitness Friday, and the latest analysis from Lance Roberts and Michael Leibowitz. Subscribe and bookmark our YouTube channel for The Real Investment Show, or just click on the show links at realinvestmentadvice.com.
You're listening to The Real Investment Show.
So, as is always the case, when interest rates go up a little bit, everybody starts saying, that's the death of the currency, right? And Mike and I wrote several articles about de-dollarization 2 years ago when the dollar was declining and interest rates were moving up. And then, of course, the dollar has absolutely surged over the last couple of years. In fact, we've had some of the strongest runs in the dollar. In fact, the dollar is now trading at some of the highest levels that it's been at in the last 40 years. So the reason for that is that everybody in the world, the rest of the world, they're going, where do I want my reserves? I want my reserves in the US dollar. And so they move money into the US. They buy US assets, they buy US treasuries, they buy, US real estate, whatever it is, because when I buy a US asset, I get that conversion into dollars. And so basically I'm storing my foreign currency. So if I'm in, France, I'm storing my French francs in the US dollar. And that's where the reserves come from. And that's why the dollar moves up. So again, one of the issues we've seen is that people want to have the US dollar as a reserve. Why? And Mike explained this earlier, is that the U.S. economic growth is vastly above the rest of the world. In fact, we're the only country actually growing economically right now versus the rest of the world. China, Britain, France, Germany. Germany's in just a tremendous boatload of trouble economically, and that's the largest country in the EU, and they are very, very close to recession. And again, this is a major trading partner with the U.S. China is just having a miserable time right now economically. Inflation-wise, their inflation's dropping sharply. Economically is dropping sharply. They are a major trading partner to the U.S., so we import that deflation through our process. But let's talk about this whole issue. People running around talking about, it's the fiat currency. There is zero non-fiat currency in the world. Gold is not a currency. What is first of all, let's define what a currency is. A currency is an accepted means of payment authorized for use. So in the U.S., it's the dollar. And that is a piece of legal tender that we can now use to barter for goods and services, because that's all you're doing. You're just bartering for goods and services, and you use $1 for that. So I take a dollar bill out of my wallet and I, go pay for a cup of coffee, whatever it is. That's a currency. Behind that currency is the full faith and credit of the U.S. government. The government says that currency is acceptable for trade, and we will guarantee and honor its value. That's why people buy U.S. Treasuries, because they are guaranteed by the government. Behind the government is roughly about $200 trillion in assets, if not more. Gold reserves, oil reserves, federal lands, federal production, real estate, buildings, you name it. So even behind the asset itself of the currency, there are trillions in assets to back that. Yes, the dollar is printable. Yes, we can print our own currency, which gives us sovereignty. And very important, this is one thing where this is where the Eurozone really messed up a few years ago. When they created the euro, they did not create a monetary union. So they all gave up their ability to print their own currency. So now they're dependent upon the Eurozone itself to print currency. Germany can't print Deutschmarks, as an example. So if they get in trouble, like they are now, they're going to have a bit more trouble managing their economy. We don't have that disadvantage. Bitcoin is the biggest fiat currency on the planet. There is nothing behind Bitcoin. It is solely sentiment. It is, I want to buy it, so I drive it up in price. If I want to sell it, I sell it. But there's no guarantee of asset. And I can go just print another. If I don't like Bitcoin, I can go create another cryptocurrency. I can't go create another dollar. So from a fiat basis, things like gold, which is not a currency, is a fiat, right? Gold moves up and down in price solely on sentiment. I can't take gold down to my local Starbucks and buy something with it. It is not legal tender. That was outlawed under Nixon. So this is a lot of fallacy that's put out there about currencies, about fiats, that you need to kind of just come to terms with. And that ultimately at the end of the day, the fiat system is not going away. People are not going away from the fiat system because everything in the world is fiat. There's no non-fiat currency. And if you try to put the US dollar back on gold, you talk about inflation. There's not that much gold to back the trillions of transactions that we have going on globally around the world. The US dollar is the deepest, most liquid currency in the world, backed by a rule of law. And that's why people use it for trade everywhere in the world. About 70% of all transactions occur globally every single day in the US dollar. Mike, I'll let you take over.
Yeah, that's a great point. And Lance, just as a side note, did you know that the US government is one of the top 5 holders of Bitcoin? And the reason it is because of, I forgot the name of that scam, the fraud.
Right.
But
FTX.
we took over a lot of Bitcoin as a result of that. And yesterday or the day before, Biden authorized the Department of Justice that they can sell it. So, that's whether that's an FU to incoming Trump.
No, I'm sorry. I said it was the FTX scam. No, that Bitcoin you're talking about was from the Silk Road.
Right, exactly.
Yeah.
And they're authorized to sell that. I think that's interesting because they are one of the top 5 holders in the world. Mm-hmm. And if they do that, that's, potentially problematic for Mr. Saylor, who we've talked about.
Right.
But getting back to the topic. So the question is, we have our model, we know what the sentiment is. So what's driving the sentiment? And I think there's 2 big things, a lot of little things. One is high deficits. And don't shoot the messenger, but yes, deficits are high. Our spending is too much as a government. We have debt problems. We've had them for 50 years, and they're not getting any better. They're getting worse. But when someone says, oh, the debt's up 12 trillion since COVID, there's no context to that. The context is that the economy has grown 9 trillion. So when you look at debt to GDP, it has increased, but for the last 2+ years, it has been flat. the level of debt to GDP. So yes, these deficits are much higher than they were, but the size of the economy is also much higher. The ability to tax the economy is much higher. Then when you kind of dig into the deficit, you'll notice that 700 billion of it is just from interest expense. So I'll tell you what, if Trump wants to get the deficit down, you can fight Congress and you can try to save $1 billion here and $100 billion there, or you could just get interest rates down. If interest rates go back to where they were, you're going to reduce the deficit by 700 billion and get it back into a normal range. So, you got to put the deficits into proper context. And not that, again, don't shoot the messenger because they are a problem, but they're not as big a problem, I think, as being portrayed by some of these bond bears. Second one is inflation. We had inflation for one reason. We printed money, we provided a ton of stimulus, and the supply lines were shut down. More demand, less supply equals inflation. You learn that on the first day in Economics 101. That's basic, right? That has more or less normalized. Doesn't mean inflation's all the way back to where it was. It's still higher than it was, and there's still some lags. Like insurance, it takes a while for insurance to work through the system. Car prices have risen, but until those cars get in accidents, the car companies don't start raising rates. And when they realize that car repairs are much more than they were, that's when they raise rates. And that's why it can take 2 or 3 years for those prices to go up. The other important part is that a third of inflation is shelter prices. And we've talked about this before. But bottom line is they lag significantly, and it's because of not faulty data, but the way they collect the data. They basically ask you what your rent is. They should only be looking at rents that are signed this month. When you look at car prices, it's what's the price of cars this month. With rents, they're looking at a whole range of rents going back 2, 3, possibly even more years. So it's not accurate. The Fed knows it's not accurate. The economists know it's not accurate. And when you look at CPI, excluding shelter, it's below 2%. It's on the lower end of the range of where inflation was prior to the pandemic. So yes, inflation may be a little sticky at these higher levels. It could even jiggle up a little bit. But those forces that created inflation are long gone. And the deficit is high, but unless it's going to surge, unless it's going to grow by a lot more, the addition of more deficit spending is not going to have a massive effect on inflation. So, look at those narratives behind the sentiment, and they're greatly flawed. And when that sentiment fades, and the sentiment could fade because of the sentiment itself, you've pushed yields to the point where you're going to start breaking the economy, which lowers GDP, it lowers inflation, and the narratives kind of fade. So it's kind of circular there, but
well,
there's a lot more in the article. It's hard to summarize this in such a short period, but it's worth thinking about the value of sentiment and what drives it and what could collapse it.
And again, this is stuff that you're going to go into a lot more detail on at the Economic Summit Saturday after next. So be sure and get by the website and get your tickets. Come see Michael's entire presentation on bonds, interest rates, inflation, where this kind of eventually winds up over the next couple of years. And that's all on Saturday, January the 18th, here in Houston. Live event only. Again, no recordings, so we won't be putting this out later. So you need to come. Tickets online right now, realinvestmentadvice.com. Y'all have a great weekend. See y'all back here on Monday.